Hi, thanks for listening in. My name's Davin Clarke. I've been a professional trader for around 12 years. My primary income has been all through trading over that time frame. And I just wanted to show us a strategy today that is a simple trading strategy. It also has exits, which I find a lot of other people really struggle with. I've struggled with it over the years. I've found something that I think works well as we are trading the unknown, and it allows us to be able to define our points of where we are in the market and assess our risks as we go through a particular trade. So I just wanted to show, this is the yen futures contract against the US dollar. This is on what we call a Renko chart, which takes out a little bit of the noise in the market and allows us to view the structure of the market. What I also have in here is some moving averages. Really, moving averages are just to show what position of the market we're at any point in time. It's not a trading signal in and of itself. The way I structure my trade style and my trade entry is, what I want to try and do is try and get price action when it's moving from a congestion zone into an expansion zone. So I'm looking at early retracements in that congestion zone, a little bit of a hint that markets might be moving from that point to a directional mode, and trying to time trades with that. An example here that I'm looking at is here the 20 and 50 moving average crossover on this Renko chart, which is set at 4. This smaller line here is a longer term moving average. It's a 200 moving average, and it shows me that the market's fairly flat. Market price action's been congesting. We've broken a level to the downside, which is a minor level downside. We've moved to a low point there, 102.36. The first reaction is the area that I'm looking to trade to try and capture the market early before other traders move into a particular trade. So I want to be in first. I want to sell out my position to traders as they see the outcome become known. So at this point, the outcome is unknown, but when the outcome is unknown, the risk is generally at its smallest point. I'm looking for a reaction here. We get a 2-bar move to the upside, then 1 bar down. Now, normally I'd be taking a trade entry on this shallow reaction 1 point below that low. Now, we never actually achieved that. Moved up another couple of points here. You can see on our proprietary momentum chart down the bottom here that price action has moved upwards here. Where we start turning over, just in here, is the first bar close in here. So a point after that is potentially where I'm looking to enter that trade. If we just draw that in here. Now at this point I can keep my risk quite small. You can see the prior highs here. An exit strategy might be if it breaks the highs. Even if it breaks the inside of the actual bar by 3/4, I can start reducing my size. What I like to do is enter on full size, so enter a position quickly but with tight stops initially, because I'm looking for contraction into expansion. Let's say it's 5 mini contracts as an example, or 5 contracts on the yen here. We get movement down. What I like to do then is to scale out into expansion. So I'm looking for areas where price expands and then the start of reactions off that area. Price action breaks down to the downside. We get to a low point here, and we get our first reaction in here. So what I'm looking at is, as that's a reasonably extended zone into that on the short-term basis, I'm looking to potentially exit 1/5 of the position into here. Now if we're trading the cash market with currencies, we can trade in much smaller amounts than say with the futures, where we've got to carry full contracts. Often it's a good idea to have a look, if you're able to be able to trade the cash. If you're a fairly new trader and don't want to trade a large size, then being able to trade in mini contracts of the cash market, 1/10 of a full-size contract, could be a way to get started. Let's have a look at this move. We've got a move down. We get our first reaction here. So I'm looking to sell out a portion of that particular trade. I might sell out my first lot there. We get another reaction downward, then another pop up. Maybe I'll look to sell out my second one in here. So what I'm doing is, I've looked for expansion, I'm looking for reaction. Now because we don't know that the market's going to get to this end point as the market's trading hard right edge, this price action could continually move up at this point. We just don't know. We've also, if you have a look, we've moved down to the next level and we've started basing off that. So there is a chance that this becomes a double bottom and price action moves up. What I've done now is I've reduced the size down from 5 contracts to 3 contracts and locked in a profit of that distance between the entry point and those 2 exit points. What that does is gives me 2 things now. It means there's more room for the price action to move before it hits my entry point and before it hits my break-even point. What we find with markets is they do spend, especially in these congestion zones, even if we do get breakouts, they can often chop around a little bit. So we need to be able to manage our risk at all times. With this particular setup, it goes our way straight away initially, which is great. We close out position into a risk area. Price action then continues the downside trend. Now what I am aiming to do is, as price action expands directionally for me, think about the traders on the other side of the trade, the traders that are trying to look for bottoms in the market. Now, we all hear about traders that do try and pick bottoms are usually the ones that get squeezed out. And we're trying to, by scaling out into these higher risk areas, but allowing our position size as a whole to capture those traders when they're forced to cover their positions. We can actually have some of our trade riding those directional trending trades that happen from time to time. So we get another move down to the lows here before we get a reaction bar. Just working off this, we now close out our 3rd exit in here, and we've locked in a little bit more profit from that entry down to the exit. So we're scaling our exits. It's reducing our potential for losses now on the trade, but it's also still allowing us a portion of the trade to be able to look for larger wins. We get a move down and a reaction off here. This is where we either take a 4th position off, or what I tend to do is, as I get more profitable, I want to open up the trade. I want to capture those big trending moves. We don't know if it's going to be a big trend on this particular day, or it could close up and reduce our potential winning percentages. What I do find though is, if I can capture these moves and open up the last few, remember we've locked in quite a reasonable amount of profit here. Even if this moves back to a break even, we've made a profit of at least 1-to-1 on the trade. I'd expect it would be more from this position. So the aim of the game is, over a sample size of trades, is to make sure that on our winning trades we're getting a better than 1-to-1 reward to the initial risk that we're taking, and that's the aim by entering in these particular areas. So as price action gets down to this level, I'd possibly be looking for just closing out 1 contract and seeing if we get some more directional movement. Remember, we have come from a contracted area, we're moving into an expansion area, and traders on the wrong side of the market, the traders that are long in the market, are the ones under pressure, the ones sweating this out. And generally, traders that are caught on the wrong side of the market are usually the ones that pay for the traders that are trading directional movement. So we get a move up, reaction back down, it drives down to a lower level. Now this could be a much better area to get our next trade off. Moves up fractionally, reversal back down, and then we get that low point here, and we can look at closing out our 5th position. On this particular trade, with our initial area and our risk small, we can see that our reward to risk has been much greater than 1-to-1. It's been, haven't got the numbers in front of me, but it's been quite a large reward to risk. Now as we move forward into the session just operating now, what we're looking at is 20 and 50 crossing positive, the 200 MAs from a downward move to a flat move, and a very similar setup to the setup on the short side. So now we're looking at the long side. This is in play now. Potential area to work the long side of the market, and we get a little move up. Maybe we even close it at contract out. It's a consistency we need to develop through a bit of practice here. Price action then moves up to our next leg. We don't get a reaction till over here, so let's say we're out of 2 contracts now. The market, if it comes down and fails, that's okay. We've made a profit on those 2 positions. We're capturing the movement out of a congestion area into an expansion area, which is the whole aim of the game as a trader. and we're looking to see if this market can drive higher in the short term, and see if there is a trend in play, then we want to maximize those extensions. Hopefully this gives you a small overview of a trading strategy that has risk management, has reward that's greater than 1-to-1, has areas to exit the market into potential counter trend moves, and allows us to be consistent and trade with the overall directional movement of the market. Now, if you'd like to get some more information about what I do as a trader, also some of the indicators that we use for our trading, have a look at the link below. Our website is www.globaltradingtools.com. We'd love to hear from you, and thanks for spending the time. Hopefully this information was worthwhile to have a look at. Thanks very much.